Last part of this chapter is talking about money creation. So basically what's happening here is we're going to learn about how a bank could take in $1,000,000 and that could actually turn into $10,000,000. That's where it gets interesting. So basically the banking system can create money through a process of making loans. All right, so here's how it goes. Let's start with this bank where, let's say, Bill Gates comes in, deposits $10,000,000 in Singleton's bank. Singleton could take this $1,000,000 and do whatever they want with it. Let's say they put it into reserves. They haven't touched it. So it's just sitting in their vault, not doing anything. Now, they could make loans with it, all right? Because if it's just sitting in the bank, it's not earning any interest. Okay? So what you need to do as a bank is you need to make money. So you will be selling loans. Let's say that they give a loan to Hank's Auto Supply for $9,000,000. So they're going to loan out $9,000,000. They have $1,000,000 in their vault. So they still have something. They didn't give it all away. So this alters Singleton's balance sheet. It now has $1,000,000, which is 10% of the demand deposits. Okay, so you have your deposits of 10, all right, and they held $1,000,000 in reserves. That is 10%. So for this economy, let's say your reserve requirement is 10%. You are required to hold 10% of your deposits as reserves. So all you'll do is you'll take your deposits, multiply by the required reserve ratio, such as 10%, and this gives you your required reserves. So for instance, we have demand deposits of 10,000,000, so we'll multiply this by 10%, and this will give us 1,000,000. So this is our required reserves. So you're required to hold 1,000,000 in reserves, so you can make loans with the rest. This reserve requirement could change, but let's just assume it's 10%. So Hank's Auto Supply is now going to take that $9,000,000 and they're going to buy machines with it. Okay, so when they buy machines with it, that firm is going to take that money for selling the machines, and they're going to put that in their bank. So they're going to take that and put it in their bank. So this bank, let's call it First National, is going to take in this $9,000,000 as a deposit, okay, and they're going to put it in their bank as reserves. Now, the bank lending has expanded the money supply by $9,000,000. How did this happen? Well, Bill Gates came in, put in 10,000,000. We created loans with it, and then we were able to take that 10,000,000 and buy a $9,000,000 machine with it. So we were able to expand the economy by $9,000,000. So the money supply expanded by 9,000,000. Now, First National could loan out some of this money. They could loan out, hold on, got to multiply by 10%. This is equal to $900,000. This is the required reserves. So you are required to have $900,000 in your reserves. So that means you can loan out the rest. So if you had $9,000,000, you have to keep $900,000 in the bank. So you can loan out $8.1 million. So now you can take this $8.1 million, and this bank is going to loan it out to Jack's Chevy dealership. Now Jack Chevy can deposit this loan in whatever bank that they want. Let's call it Second National. So Second National is going to take this $8.1 million, and they can make loans with it. Okay, they're going to take some and put it in reserves. They'll take 10%, which is $810,000. they need to put this much in their reserves, and they can have the rest as loans. Okay? Making loans, 9 million, 8.1 million, this is extra money that we're using in the circular flow for society. Making loans that are then deposited into a demand deposit account increases M1 because we have more money in circulation. This money creation is possible because there are multiple banks in the financial system. You're able to take that money, go to a different bank, and that goes to a different bank and goes to a different bank, all by making loans. They are required to hold a fraction, the required reserve ratio, in reserves. Okay? And so what happens here is we are increasing deposits and we're increasing the money supply. So this leads us to the money multiplier, where basically you are having this amount of money that you have, and it's going to multiply because of loans. If all banks loaned out their excess reserves, the money supply will expand. In a multi-banking system, institutions determine the amount of money that the system can create by using the money multiplier. So basically what you're going to do here is you're going to take the required reserve ratio and you're going to do 1 divided by that number. So for example, if it was 10%, you're going to do 1 divided by 10%, and that equals 10. So by multiplying the money multiplier by the excess reserves, we can determine the total amount that money has been created. So if the required reserve ratio is 10%, and your bank's excess reserves, or how much money you can make off of loans, is 9 million, you can then turn this into 900 or 90 million. So that 10 million deposit that went in is then going to turn into $90 million. Okay? So a money multiplier could have a smaller effect for the following reasons. A bank could choose to hold extra reserves. Basically, instead of holding at the 10% mark, they could hold it at a higher rate. And so if they're holding more reserves, that's less loans being made. And if less loans are being made, that's less increases in the money supply. In a recession, banks are more likely to hold more reserves because they don't want to lose those loans. They don't want them to default. So customers are less likely to repay loans during a recession. So during a recession, you're not going to see banks loaning out a lot of money. The Federal Reserve also may raise or lower the required reserve ratio as a policy to move or affect the quantity of money in the economy. So if we change the ratio, such as, let's change it to 8%, and we do the money multiplier, which is 1 divided by 8%, this is going to equal 12.5. So that same $9 million is now going to be multiplied by 12.5. And so now, because the required reserve ratio changed, this changes the change in the money supply. So that could also change the money multiplier. And then additionally, if people don't deposit all the cash, so if Jack's Chevy dealership only deposited, 50% of the loan, then they're keeping 50% at their house. We're not able to make loans with the ones that's at the house. So we're not going to have the full multiplier effect. So these are going to be the different things that affect the money multiplier. Okay. So what we did in this video was we talked about the bank creating money by making loans. So whenever there's a deposit, you have to take out required reserves. Whatever that extra that you have, you can make loans with that. Whatever that extra is, you multiply this by the money multiplier, and this tells you how much the money supply is going to change. Okay? So that's how it goes. In the next video, we'll talk about monetary policy. I'll see you there.